David, on the Bloomberg, I can look at CPI inflation back to World War I, and the average over the many 110 years is 3.1%. Part of that are the spikes up, which are hugely stochastic and come down quickly. Will we disinflate rapidly?
I think we will, Tom, and I think that you're already seeing it in a lot of indicators. I'll mention three. Commodity prices are well off their highs. Even though oil prices have hung in the past couple of weeks, they're down more than 20% from the peak. Base metal prices are down 25%. You've got lumber is down more like 70%. So the commodity complex, which hasn't shown up yet, in that 40% chunk of the CPI called goods, the stuff that you can see,
Right.
touch, and feel, commodities are deflating. You've got freight costs across the board. I mean, look at the Baltic Dry Index.
Yes. I want to stop there, David. David.
The U.S. dollar is up 12% year over year. Does anybody in the world think that you've seen all the pass-through
Right.
From the strength in the dollar into goods prices? And the answer is no. This will all show up in the next 12 months.
David, Liz Ann Saunders featured Baltic Dry Index yesterday. Explain to our global audience the symbolism of the cratering of the Baltic Dry Index.
Well, I think a lot of it is the byproduct of the fact that global demand is coming under downward pressure. I would also say that we are seeing, notwithstanding the ongoing war in the Ukraine, which doesn't seem to make the front pages of the paper anymore, you are starting to see an unclogging in a lot of the port congestion globally. And so you're seeing the supply side thaw out. Where you're seeing that most evidently, Tom, is in the survey data on supply delivery delays, which have come down dramatically across every single survey. Richmond Fed, Kansas City Fed, Philly Fed, New York Empire. And, it's very interesting from a Fed perspective is that, about 5 months ago, Jay Powell said that, we're going to operate policy blindly relative to what's happening on the supply side. The Fed made a decision 5 months ago that we're just going to concentrate on demand destruction, getting demand growth below supply, which I think is a wise policy. But you see the supply side is finally taking hold and creating the disinflation before you've ever even seen any of the lagged impacts that the Fed has already done, through rates and QT on the demand side. So you have the supply curve actually becoming more elastic at a time when the Fed is engaging in a policy that's going to really kill demand. So explain to me, as we get the chalkboard out and you draw these demand supply curves, how does inflation not absolutely collapse in the next year? I say this to my clients. They look at me like I'm crazy.